In this video, we are going to look at the macroeconomic environment that companies operate in. We're going to look at fiscal policy, monetary policy, how these two kinds of policies interact in the policy mix. We're going to look at economic growth and productivity and how you measure productivity. We will take a quick look at the modern money theory and at open versus closed economies and what is possible in terms of monetary and fiscal policy under each. And then we'll look at the zero growth debate. So beginning with fiscal policy and how we calculate gross domestic product. Countries began to collect income and expenditure statistics after World War II. Gross domestic product is derived on an income basis or an expenditure basis. Income-based GDP constitutes compensation to employees in terms of wages and salaries, gross operating surplus, the operating surplus and consumption or depreciation of fixed capital, gross mixed income, taxes minus subsidies on production and imports, and a statistical discrepancy. We're going to look at expenditure-based gross domestic product, which includes personal consumption, government spending, investment spending, net exports, and a statistical discrepancy. So if we look at the expenditure-based measure of GDP and there's no government involvement or any trade, then we find that income Y or expenditure Y is equal to consumption expenditure, final consumption expenditure that is, and investment, which is expenditure on investment goods. We can rewrite this as output or income minus consumption is equal to investment. Since income minus consumption equals savings, we therefore can say that S equals I. If we include government, we get the relationship that national income, or GDP, Y, is equal to consumption plus investment plus G, which is government spending. Adding and subtracting T, taxes, and rearranging, we get that income minus taxes minus consumption plus taxes minus government spending has to equal investment. Investment equals savings, and savings could refer to personal savings and government savings. Now, fiscal policy is when the government uses its spending and taxation power to influence the economy. So there are four items that we need to consider here. First, government spending, G. Government expenditure on goods and services such as education, healthcare, infrastructure, and defense, but also all kinds of government expenditures are included here. Taxation is number 2, T. This is the revenue collected by the government from individuals and businesses. Taxes can be progressive. In other words, they increase as a proportion of income as income rises. So at the marginal rate of taxation increases as you have more income. They can be regressive. Certain types of income taxes are going to fall as income rises. Think of simple goods and service taxes, which tend to decrease as a proportion of income, or proportional. In other words, it's constant regardless of income, which is often what many people would prefer. 3 is the budget deficit or surplus that has to be taken into account. This is the difference between government spending and tax revenue. Budget deficits occur when government spending exceeds tax revenue, so G minus T is greater than 0, while there's a budget surplus which takes place when revenue exceeds government spending, so tax minus government is greater than 0. And the government debt then is a measure of the accumulated deficits minus surpluses given by debt is equal to sum over a period of time of G minus T, where the summation represents the accumulated deficits over time. So the sources of government funds for spending: taxes and royalties. So far we've not talked about royalties, which are usually levied on natural resources, for example, Whenever the government sells liquefied natural gas out of British Columbia, both BC and the federal government are sure to take their shares, but it's the royalties that go to the province because the province owns the natural resource. For example, the province also taxes lumber exports and that. Taxes are the personal income taxes, corporate income taxes, tariffs on goods entering the country, sales taxes, licenses of various kinds, for example, fishing licenses, automobile licenses, driver's licenses, and you can continue. Royalties are the charges on natural resources such as trees, coal, oil, minerals, and metals. Then the government can borrow. It borrows at the market rate of interest, consisting of a risk-free rate plus a risk premium based on perceptions regarding the government's ability to pay back the loan. Borrowing implies deficit. If the economy grows at a faster rate than the interest on the public debt, tax revenues rise faster than debt repayment, a healthy situation. We'll come back to that when we talk about zero growth economies. The problem is that the government borrowing can lead to higher interest rates and thereby crowd out private investment. This is a real problem that occurs at times. And of course, the government can print money, which possibly leads to inflation. So what about monetary policy? Monetary policy involves control of the money supply and interest rates by a central bank to achieve economic goals. So the tools of monetary policy are six. First, the money supply, M. Total money circulating in the economy comprising of currency, demand deposits, and other liquid assets. So we denote that as M, money supply, is equal to MC, currency in circulation, plus D, referring to demand deposits. Now there are different measures of money supply. There's usually an M1, which is simply currency in circulation plus demand deposits. Then there's M2, which includes those and somewhat more items as well, as discussed in chapter 3 of the textbook. Number 2, the second tool is interest rates. R, the cost of borrowing money or the return on savings. Central banks can adjust interest rates using the bank rate, we'll discuss that shortly, to influence borrowing, spending, and investment. Number 3 is open market operations, buying or selling government securities to control the money supply. There's a term, FOMC, which refers to the Fed Open Market Committee. This is the Federal Reserve of the United States, which is their central bank. This is their committee that makes the open market decisions, how much buying and selling of government securities will occur. A fourth monetary policy instrument is reserve requirements. The percent of deposits that banks must hold as reserves. Although financial institutions are not required to hold reserves anymore, instead they are required to ensure that they do not have a negative balance in their settlement accounts at the end of each day. Now, commercial banks can borrow from the federal or the central bank or from each other. We'll get to that in a little bit. The fifth tool of monetary policy is the bank or the discount rate. It's the interest rate at which banks can borrow from the central bank. And finally, there's inflation targeting. Central banks aim for a specific inflation rate to maintain price stability. Inflation targeting involves adjusting monetary policy to keep inflation within a target range. Currently, that target range is about 2%, and this is what we always anticipate. Every second month in Canada, the Bank of Canada will set a new, or it'll make a decision about what the target rate should be. The bank rate is the target rate. Primary tool for central banks to use to control inflation is the overnight rate, also called the policy interest rate or the target rate. So this gets very confusing, all these different terminology that's used to describe the bank rate. So what is the target rate or the policy interest rate? It's financial institutions are encouraged to balance their payments from one day to the next by borrowing from each other overnight. For one day, in other words, at this policy or target interest rate. Alternatively, they can deposit funds, if they have extra funds, at the central bank overnight, earning interest at the deposit rate, or they can borrow funds from the bank at the bank rate. In Canada, the deposit rate is now set equal to the target rate, although previously the deposit rate was 25 percentage points, 0.25 percentage points below the target rate. And the bank rate is slightly higher by 0.25% than the target or the policy rate. And remember, the bank rate is what banks borrow at. So the target or the policy rate is set by the central bank to balance unemployment and inflation objectives. Rather, I should say, it's set by the central bank in an attempt to balance unemployment and inflation objectives. A more flexible approach is to set the policy rate to aim for an average 2% rate of inflation, which permits more room to adjust rates to address unemployment. Commercial banks and other financial institutions then set their mortgage rates and other lending rates based on the bank rate. So what's the impact of bank rate changes? Well, low rates of interest encourage consumer spending and investment as the cost of borrowing money is lower than the usual or expected rate of interest. Consumption increases because the cost of taking out a loan to purchase durable goods or a new vehicle or a new house or whatever is less. Investment, meaning the purchase of physical assets such as machinery, new buildings, roads, housing, rather than financial assets, increase as investors can earn higher rates of return than the market interest rate. So think about it. If you're able to earn 5% on some kind of investment, but the bank rate is 6%, you're not going to invest. If, however, the bank rate is 4% and you can earn 5%, you'll invest. And of course, that depends on uncertainty and risk as well. Potential housing bubble. So when you lower the interest rate, there's the potential for a housing bubble as people use low borrowing rates to invest in housing that is expected to rise faster than the interest rate. There's also the potential for a liquidity trap where low rates of interest no longer affect spending behavior. In other words, you can try and lower the interest rate, but any attempt to lower the interest rate no longer affects behavior. And we saw that during the COVID. A higher bank rate incentivizes a reduction in consumer spending and economic activity more generally, and thereby signals and brings about a reduction in inflation. So think of the thing about the 5%. If I can earn 5% and the bank rate is 4%, I'll invest. If the bank rate is higher than my investment rate, I'll invest money, and that incentivizes less spending. Now we talk about reserve banking as well. We mentioned that as one of the tools that the bank would set reserve rates. Some countries still employ a system of fractional reserve banking, which means that the commercial bank has to hold reserves with the central bank in the form of cash, known as vault cash, or deposits at the central bank. Reserves are a fraction of the bank's deposits, known as the reserve requirement, to ensure that banks have enough liquidity to meet the withdrawal demands of their customers. Central banks in Canada and the US recently did away with reserve requirements, although what remains acts a lot like a system with reserve requirements, as I noted on the earlier slide. So what are treasury bills, also known as T-bills? A T-bill is a short-term government debt obligation, a money market instrument issued by the government as a promissory note of repayment in the future. Its purpose is to secure funds to meet short-term financial requirements of the government. Banks hold T-bills as they can be easily converted to cash or used for other purposes such as collateral in borrowing operations. T-bills are highly liquid and low-risk assets. And T-bills are sold in the open market at a price that fluctuates with the bank rate. If at the time of purchase the interest rate is less than the interest on an existing T-bill, the current value of the T-bill is higher, and vice versa. If the interest rate is higher than the interest on the T-bill, then the value of the T-bill goes down. If central banks purchases T-bills from banks, from commercial banks, so if the central bank purchases bills from commercial banks and securities dealers, those institutions have more cash, raising their reserves. They will lower reserves by increasing lending, which stimulates economic growth, economic activity. For every dollar in cash reserve, a bank can lend $10 to $20 based on reserve requirement. So the money supply goes up by multiples of the cash that came in. So we have a multiplier effect. Purchases of T-bills by the central bank has been referred to as quantitative easing. Quantitative tightening, on the other hand, occurs when the central bank sells T-bills, leading to a slowing of the economy. So now we come to the velocity of money, inflation, and unemployment. The velocity of money simply refers to the rate at which the stock of money, M, turns over. It is determined by the value of all transactions divided by a given money stock. The value of transactions can be thought of as represented by Y, output, or aggregate income, or gross domestic product, is equal to V, the velocity of money, times the money stock, or the money supply. Further, Y can be considered to be price times quantity, where Y is nominal income, or GDP, Q is the quantity of goods and services, and P is the price of those goods and services, so a general price of all goods and services in the economy. During the COVID pandemic, quantitative easing, QE, was no longer able to stimulate the economy. Thus, massive government deficit spending, rapidly rising debt, was used to prevent recession. The fear then became inflation. As we can see from this relationship, P times Q equals C plus G plus I. If G goes up a lot and Q doesn't change much, and it couldn't during the pandemic because of lockdowns, then what's left is P has to go up. So the government spending did lead to inflation, although it didn't show up right away. It showed up after the COVID pandemic really was starting to end. And we see that here where you can see this spike over there in the inflation rate. And it occurred, notice, in the European Union, in Canada, and in the USA. So what's the effectiveness of monetary and fiscal policies? Well, the relationship used by central bankers is this one here. Price times that quantity is equal to the velocity of money times M. And this is really a relationship that can be probably attributed to Milton Friedman. Now, it is assumed that the velocity of money is about 1.7 and that it is stable. So in other words, if we have $100 in circulation, about $170 is being spent during that period of time. So an increase in the money supply will increase prices if Q does not increase. So during the pandemic, as I mentioned, the money supply increased, but prices remained stable with interest rates near zero. This led some to argue that government debt was not a problem at all, because it could pay off its debts by essentially printing money. And that's the modern money theory, MMT. It's unlikely that V is stable, however, at 1.7. Empirical estimates of velocity of money indicate it varies between 3.1 and 12.0. This helps explain why inflation was not as bad as expected despite large increases in the money supply. Basically, what happened is the velocity of money changed. And there was some indication that as the government increased its money supply, that companies were just holding on to it. They weren't passing it through. The problem is that economists have some good ideas about how the economies work, but there's no solid theory that works in all circumstances. Thus, there are limits to the working of fiscal and monetary policies. So then we come to the issue of open versus closed economies. This is work that was done by Robert Mundell, a Canadian who won a Nobel Prize for this work, and Marcus Fleming. They highlighted the policy trilemma that a country cannot simultaneously achieve the following three objectives: fixed exchange rates, independent monetary policy, and free capital mobility. The exchange rate regime critically determines the effectiveness of monetary and fiscal policy. So if we look at an open economy such as Canada, in a fixed exchange rate system, monetary policy is constrained because it must be used to maintain the exchange rate. Fiscal policy therefore becomes the primary tool for managing aggregate demand. In contrast, a flexible or floating exchange rate system allows monetary policy to be independent as the exchange rate adjusts automatically to external shocks. The exchange rate adjustments help stabilize the economy. However, in that case, fiscal policy plays a secondary role. In a closed economy, such as the US, where there's no trade or capital flows, but of course there's some of that in the US, but it's small compared to the size of their economy, then Mundell's ideas converge with traditional Keynesian views. Both fiscal and monetary policy can independently manage demand since exchange rate considerations are essentially irrelevant. So now we go to economic growth. Due to Solow and Swan, it's often called Solow-Swan growth. It has 5 components. It has a production function. Y is a function of capital, K, labor, L, and technology, A. We can write this as this function here, which is known as a Cobb-Douglas production function, where alpha is capital's share of output, and it's between 0 and 1. All right, so this is basically, if we take the logarithm of this, we get log y is equal to log a plus alpha log k times L. Pardon me, it's not a plus, it's log a times alpha log k times 1 minus alpha log L. I still have this wrong. It is additive. Log A plus alpha times log K plus 1 minus alpha times log L. We also have savings and investment. I equals S little s of Y, where S is a proportion saved and it's invested to increase the capital stock. Depreciation is the first derivative of the capital stock with respect to T, which we denote K with a dot above it, and it's equal to investment today minus depreciation rate on capital. The capital stock depreciates at a constant rate, delta over time. Discrete time version of this is delta K over delta T, I minus delta K. And population growth is the derivative of L with respect to T, denoted L dot, is approximately the change in L over the change in T, and it's equal to NL, where we assume that labor grows at a constant rate N. Then technological progress is assumed to continue at a constant rate G. So if we define little k as per capita capital, so in other words, the amount of capital per laborer, and little y as per capita output, then we say that both of these grow at the rate of technological progress given by G, and as a result, long-run growth will equal technological progress. So how do we calculate total factor productivity? First, we calculate the growth rate of output, the change in y over y. Then we estimate growth rates of inputs, the change in capital over capital, and the change in labor over labor. Then we apply factor shares, alpha and 1 minus alpha, to the input growth rates. So recall the Cobb-Douglas production function, A equals K to the alpha, L to the 1 minus alpha, where alpha is the proportion or factor share going to capital. Then we deduce the total factor productivity growth as the residual. The change in A over A is equal to the change in Y over Y minus alpha times the change in K over K minus 1 minus alpha times the change in labor over labor. Labor productivity is equal to average output per worker, Y over L, and it's equal to GDP over labor. Now, interestingly, Canada's GDP has recently gone up, but per capita GDP has gone down. Here's a figure that shows labor productivity of selected OECD countries and the European Union as a whole. And we see the green columns are purchase power parity converted constant prices for 2015, and the orange columns are current prices, again, purchase power parity converted. And we see that Canada's growth rate or productivity, labor productivity, is below that of the United Kingdom, the United States, the European Union, and Australia, but ahead of that of Japan and New Zealand. We can also look at labor productivity of selected countries. This was 2019, and we see that labor productivity is highest in the United States, followed by the Netherlands, Germany, Australia, and Canada was ahead of China, Russia, and Japan. But this was 2019, before the pandemic. Now, many are proponents of this zero growth economics. Well, is that realistic? Sustainability, among those who support zero growth economics, sustainability is preferred to economic growth, GDP growth. In other words, sustainability is the main target, not GDP growth. And it's considered essential for long-term ecological balance. The pros are that this protects the ecology and supposedly long-term stability of the environment. The problems are it risks innovation and jobs. Remember that human aspiration is for increasing consumption. But also the finance system depends on growth. As I mentioned earlier, government debt payments increase if the interest rate is greater than the growth rate of the economy. If the economy is growing rapidly and it has debt, then the debt is not a problem. The risk of inequality rising is greater when you have no growth. We see that also with the pandemic, we've seen that. Technological progress and market adaptation counteract resource depletion, which is what William Nordhaus, the Nobel Prize winner, once noted. And Angus Madison, who has studied living standards historically since probably since the year 1000 or even beyond, argues that sustained economic growth has historically driven improvements in living standards and will continue to do so in the future. So what are the key takeaways of this chapter? Well, fiscal, spending and taxation shape demand. On the monetary side, rates and money supply are used to manage inflation, and both of these interact strongly in crises. Growth requires productivity and technology, and the big debates are about modern money theory, although I think that debate has kind of died down, and zero growth, and then of freedom versus state control or coercion, as we saw in the previous chapter. For discussion, can deficits ever be good? Should the central banks target unemployment as well as inflation? And is zero growth realistic in today's global economy?